So we have come a long way on our variation on problem P1-4B from a Financial Accounting, the 8th edition by Weygandt, Kizo, and Kimmel. We started out with Paulus Consulting and their balances at April 30th, 2014. We've got our transactions. We looked at the effects of those transactions on our accounting equation. And then we moved into how accountants would record these transactions. And we started with our general journal. And we created our journal entries. And then we took those journal entries and we posted them all to the ledger. And when we were done with posting to our general ledger, we were able to take those balances and transfer them over into the trial balance, which we saw balanced. And the trial balance is a great tool for creating our financial statements. And finally, we did create all of those financial statements. And so it seemed we were done. But we are not done because, as you can see down here, I have added some other information. And the thing that we have not covered yet in these screencasts is adjusting the accounts at the end of the month or the end of the quarter or at the end of the year, whenever we are closing our books. So at the end of the month, in this particular case, we are going to do some adjusting journal entries. And adjusting journal entries are journal entries that we do periodically because we just don't journalize some things every single day. Some transactions do not get recorded all the time. And so we just wait for the end of the month or the end of the year, whenever, and we record them. So why wouldn't we journalize some of these things? Well, some events aren't journalized daily because it would just be efficient. This is the main reason why we don't journalize events daily, is because it's simply inefficient. It would take far too much time and cost far too much money to do it. So, for instance, if we have wages expense, every day we've got employees working for us. Every day they earn their salary. So every day we could record a wages expense. But we're not going to do that because that would take far too much time. We're going to record that wages expense at the end of the month, probably. Supplies expense is another great example. We have these supplies and we use them every day. We use copier paper every day, or toner, or some sort of oils to lubricate our machines, or all sorts of different things go into supplies. We don't take into account every sheet of paper every day. That would be inefficient. Also, we don't journalize some costs every day because they expire with the passage of time. And again, that would take a long time, earn a lot of money, and it would be a waste. So, for instance, if we prepay our rent for a year, we are certainly not going to record rent expense every single day. Even though we use our office every single day and it becomes an expense every day, we're not going to record that. The same with insurance that we've purchased. We're not going to record insurance expense every day and depreciation. And finally, some items just may not be recorded. Bills that we haven't received yet, payroll taxes, those kinds of things haven't been recorded. And so they get recorded at the end of the month. So we're going to look at how we record these adjusting journal entries. And you can see that I've made some changes. Our trial balance now says unadjusted trial balance because that's the trial balance we created from all the information we had before we got our adjusting information. And I also put down the unadjusted financial statements. Generally, you wouldn't create unadjusted financial statements. You would simply wait until after you've adjusted the trial balance and then create your financial statements. But this was good practice for us. I am, however, going to hide this now. So what we do with this information is we create more journal entries. Anytime we have transactions that we can journalize, that is what we do. So I have already created those journal entries. And I'm going to move this information over here just to make it easy for us. And you can see, because I've highlighted it in red, that this is Journal 2, J2. And that's why we put the different references J1 in our ledger so you know which journal it's coming from. And our adjusting journal entries will come from J2. So I've already created, for the sake of time, our journal entries, but we will go through them quickly. First, we have account of supplies shows $400 of unused supplies on May 31st. So we had $1,000. We had purchased $1,000 worth of supplies over time, and we just weren't keeping track of who had used what paper, who had used what staples, all those different kinds of supplies. And now we've done a count at the end of the month, and it shows that we've got $400 left. Well, that means our supplies balance is incorrect. So we credit supplies for $600. That brings that debit balance down to $400, which is what we have. And we debit supplies expense for $600. And you can see the reference numbers are filled in. They wouldn't be filled in, but they are already filled in for the ledger, which I have already created. Now, our second piece of information is that annual depreciation on equipment is $460. So we had purchased equipment, and what we do with equipment is when we buy a long-lived asset, like a piece of equipment that's going to last years and years, basically it's a long-term prepayment for the use of the asset. And so we use depreciation to allocate the cost of that asset to expense over its useful life. And we will go into this more in a different chapter. We will have a whole chapter on depreciation. I'm actually going to pause this right now, and we will continue this in the next screencast.